Welcome, everybody, to another Tesla earnings live stream. Yep, today is the day that we talk Tesla earnings once again. And it kind of makes me wonder, what are we going to get? Because this is probably going to be the quarter of the strongest US dollar we have ever seen in a quarter for Tesla. Remember, Tesla produces roughly half. It's been less than. Now it's about 55% of their vehicles to sell in the United States, and anything that's sold outside of the United States is going to contribute to a foreign exchange adjustment. And I think personally, that's going to be the biggest hit to that potential bottom line. Wall Street is expecting EPS of $1.01. GAAP EPS of $1.05 expected. Tesla's beat 7 out of 8 times on adjusted EPS. They've beat 6 out of 8 times on GAAP EPS. But I honestly worry that the FX impacts on that 45% portion of foreign sales are going to be a problem, because not only do we have Tesla essentially take impairment charges when we have these sort of foreign exchange adjustments from sales elsewhere, and you could see that sort of data right here on screen. You could see sort of how many vehicles in the 3 quarters ended June were sold in the United States versus China versus in other markets. And of course, we've seen a slowdown in China. But beyond that, we know that Tesla holds a lot of foreign currencies is just sort of in reserve. In fact, let's see if we can find exactly. Oh, yep, here it is. I already found it. Look at that. There you go. This is from their last report. Balances held in foreign currencies had a US dollar equivalent of $5 billion. Okay. Tesla is regularly talked about as having $18 billion of cash that they should go spend, whatever on. They could either buy back stock, they could issue a dividend. I don't think they're going to do either of those things. They don't need to borrow money, which is great. So they're not subject to these crazy high interest rates that we're seeing. Personally, I think what they ought to do is build more factories. Please go to Texas, go to Florida. It ain't gonna be California. We know that because California's got problems with manufacturing. Go to Texas, go to Florida, build more factories. Florida is either the 3rd or the 5th. I'm pretty sure it's the 3rd largest auto manufacturing hub in the United States. Might be the 5th. What's one of those? And if Florida and Texas are both entirely encouraging of manufacturing, go build there. Have more U.S. manufacturing for batteries there, so that way we make sure we get those EV tax credits. At the same time, if you need to put body shops together in China, now's the time to do it. In my opinion, you buy the dip on China when they're issuing stimulus hand over fist with over 50,000 new infrastructure projects in the country. Get out there, spend some freaking money on building some new factories. That's my take. Like, now's the time to do that and take advantage of that, because A, you have the cash, and B, less people are hiring right now because we're probably going to go through a pretty dirty earnings recession, which, is obviously to be expected because consumers are spending less money. This morning on the Course Member live stream, we had a pretty deep look into some Generac disasters that were going on. And I'll tell you, it just wasn't good. The Generac disaster was terrible. And Generac has a lot of exposure to residential real estate, but one of the things to keep in mind is that residential real estate investments go way down when people start getting worried about their home values. And so now we're wondering, is that potentially going to affect Tesla energy, right? That could be another overhang for Tesla and Elon Musk is, hey, look, if you're selling less batteries for homes, is that going to hit the energy department? Now, personally, I'm not too worried about that. I actually think of the entire energy department as icing on the cake anyway. And we know that Elon has said they would prefer to use the batteries in vehicles rather than in home batteries, right? Home batteries, very, very high margin product. But look, let's crank batteries for vehicles as much as we can. Let's build some more factories around the world, okay? We've got to get to 10 million vehicles produced annually as soon as possible. Not only are the vehicles safer, but self-driving needs more data. The more data we get, the better. I do think that one of the reasons, by the way, we see such fantastic auto labeling, or maybe beyond auto labeling, even just full self-driving videos out of San Francisco, is because there's a lot of manual labeling that happens in San Francisco and manual simulating. So I do wonder how Tesla FSD, really performs in some of those untested areas. And I had the pleasure of being able to try FSD again just a couple of weeks ago. And I'll say it's gotten a lot better. I mean, even from 2 months ago, from this thing's going to kill me to, oh my gosh, this thing's getting a lot better. I'm very impressed with the FSD improvements, and they continue to impress me. And, even though I'm a Tesla bull, I'm not the easiest to impress. I'm critical of the things I love the most. And the reason for that is I don't want to be blindsided, okay? So like something that would blindside me in today's earnings call would be some kind of disastrous earnings margin miss. We have to, and I kid you not, there is no question about this. We must have high margin in this quarter. Here's why. Prices haven't come down yet, okay? If prices haven't come down yet and margins fall, because this doesn't impact, like foreign exchange isn't hit on this level yet, right? Gross margins has nothing to do with foreign exchange yet, or shouldn't. That foreign exchange adjustment should be later, but we'll see. I guess, it depends. It depends on every individual company has a different accounting scheme. But I suppose if they did take it into account off the top line, that'd be interesting. And we could see some margin compression in that case. But anyway, we'll see, because they'll tell us, hey, how much of a margin impact was had because of a foreign exchange, whether that's gross margin or net margin. So we'll see. Every company's different on that. But look, if we end up with a margin miss outside of foreign exchange, like adjusted for foreign exchange, and prices haven't come down yet, we're going to have a problem. So we need net of margin. So not considering, or net of foreign exchange, not considering foreign exchange. We desperately need Tesla margins to come in very, very strong. Because if they don't, and then when prices start going down, which we expect they will, then we're really going to have pain on margin. Now, remember, Tesla's earnings are expected at 405. IBM is expected at 410. We'll look at these the second they come out. So I will say, again, biggest nervousness is the impact of foreign exchange. And then when we adjust for foreign exchange, those margins better be tight. You better hope that Elon Musk is negotiating with Putin and Zelensky and Twitter while he's on the toilet. And the rest of the time, he's spending in the factory making sure these margins are on point. Okay, because a margin miss would be a disaster here. Let's look at some of the other things that we know. So from prior reports, we know that roughly 28% of individuals who are, roughly 28% of the cash that Tesla has is denominated in foreign currencies. That's not great. Let's look at some of the other items that I've highlighted here. So this, what do we got over here? This was the last quarter. To the extent we have significant revenues denominated in foreign currencies, any strengthening of the US dollars would tend to reduce our revenues. Okay, so that's going to be top line revenues as measured in US dollars. So we are going to have that FX adjustment potentially off of top line revenues. Be interesting to how we're going to parse to see how this actually works into margins. We'll see. A portion of our costs and expenses have been and continue to be denominated in foreign currencies. If we do not have fully offsetting revenues in these currencies, and if the value of the US dollar depreciates significantly against these currencies, that's depreciates, right? Our costs measured in US dollars will correspondingly increase and marginals will suffer. That's if the dollar depreciates. Yeah, okay. So let's understand a few things that we're taking away from this. First, Tesla does not hedge a lot. Tesla doesn't do a lot of foreign exchange hedging. We'll see if that's changed, but they don't do a lot of hedging. On top of that, if foreign materials denominated in, let's say, the Japanese yen are something that we're buying a lot, or the Chinese yuan, or whatever, a strong dollar makes it easier for us to buy those, assuming we have more dollars, which we do. We do have more dollars. We have like $2 for every foreign dollar we have. If and that's what we have, is strength in the dollar. The downside is what happens when we end up getting vehicle revenues in other countries and then converting them those dollars. That's the problem. So we have the bell right now. Let's go ahead and see how Tesla closes out. Ding, 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 ding. There's our bell, the Meet Kevin bell for us. Tesla ends up 0.84%. We've clearly bounced off of the 0% fib over here. But boy, that fib has got moved down It has been a painful journey here on Tesla, just straight down basically all year long. I mean, not really. You've had these sort of little rallies here, but just keeps getting rejected. First, we got rejected at the 78.6, then we got rejected at the 50% level. Then we got rejected at we got rejected over here at the 23% level. That was a bad omen for what we're experiencing now. After hours, we're up 0.25%. There could be some retail enthusiasm that could be pulling some of this liquidity out of the system, the selling pressure, that is. And that could be supporting some of the green we're seeing here before earnings. I personally don't like playing earnings because you just never know. It's a complete disaster. Okay, so we're on deck for earnings in about 4 minutes. And what I would say is you want to write down the following. Okay, ready for this? EPS expectation. I'm actually going to put this up on screen. So Tesla EPS A, we're expecting $1.01. EPS GAAP, we're expecting $1.05. Revenue, we're expecting 22.09 billion. And net, we're expecting 3.63 billion. All right, and at 1:05 p.m. Let's go ahead and throw this up on screen so that way, if you don't want to write it down, you don't have to. It's on screen. Shout out to anyone who working at Tesla or Martin or anyone. We love you. We know this is all short-term gyration crap, especially the foreign exchange stuff, you know? So like just put your head down and keep manufacturing vehicles. I think honestly, critically is though get more factories up. And maybe wait until the U.S. labor market improves a little bit for U.S. factories. We want to take advantage of those, obviously, because of the EV credits and not only having, but also having, again, 55% of our sales were in the United States last quarter. So we may as well have more factories in the United States. But I still think buying the dip on China for factories is a great purpose or great idea, especially since it's going to be a couple of years before we get those up, right? And I think there's some real potential of having more factories in the Asia Pacific region. So we'll see. Ultimately, it's up to Tesla. Get a little closer to some of the raw materials as well. Even South America. I mean, anywhere, just build. Like use this money and build. All right, I'm excited, but I'm not like terribly. I'm not going to be upset either way. I will say Elon Musk's tweet earlier was a little bit of a bad omen. Okay, so if anything, I'm more pessimistic going into this. I don't think Elon Musk's omen was good. And that was this tweet here, which is where he said, "I will not let you down no matter what it takes." And he said this like an hour and 13 minutes before earnings. And, in my opinion, that looked a little negative because it's almost kind of like prepping, right? It's kind of like, hey, guys, sorry, Diamond Handas, y'all about to get screwed. Apologizing in advance. But don't worry, I will not let you down. That's kind of what it sounds like, which is fine. I mean, that's what it sounds like to me with HouseHack, right? I tell people, look, my reputation is on the line with HouseHack. You know, if I screw any investor out of even $1 on HouseHack, my reputation goes to crap, and I'll never be able to do anything again by the time I'm like 32 or 33. And that sucks. I want to be able to keep doing stuff. So, reputation is pretty important. Anyway, one foot in front of the other, and that's what I'm expecting here with Tesla. So we'll see what happens on that earnings statement. We do have their last quarter as well that we'll be able to compare to. And okay, let's see here. It looks like the letter is out. We don't actually have the earnings summary yet, but I'm pulling the letter up right now. Q3 letter downloaded, and come on, puppy. It's downloading. Come on. Oh my gosh, the anticipation is killing me. Okay. Dude, come on, Tesla. Okay, EPS, it beats. It comes in at 105 for adjusted. The estimate was 101. The adjusted beat by 4 cents. Tesla still sees 50% annual growth in vehicle deliveries. I got the letter now. Here we go. All right, let's see what we got. Operating cash flow, $3.3 billion. Let's go. Come on, man. Do not tell me we are not going to start talking about another factory here. That is so good. So good. Then we've got profitability, 17 Okay, that's operating margin. Q3. Hold on a sec. We're gonna have to look at this operating margin here. Hold on. Where's our margin? Margin. Automotive gross margin. Here we go. Okay, we held stable with the last quarter. We held stable to when Tesla had Shanghai shut down. I mean, that's not great. That's not great at all. You could see that pretty gnarly year-over-year decline here. This was Shanghai, folks. What happened here? This was Shanghai, or should I say Shanghai? Why are we matching that? That's quite interesting. All right. Let's see what else we have here. So record energy storage deployments. That's going to slow with the real estate market slowing down. This will slow down. Initiated transition to smoother delivery and production mix. Fine. Free cash flow exceeded 8.9 billion. Fine. Raw material cost inflation impacted our profitability. Wow. We actually still had the raw material impacts, as well as ramp inefficiencies with Berlin and Texas cell production. Well, that's not great. Also, the US dollar continued to strengthen. There it is. The USD, that's probably what the hit is. So we're going to have to adjust for that, right? We'll see what happens. Illustrate on page 21. We're reaching such significant remain focused on vehicle production. Fine. All right. See quickly if the suits have any first comments. Tesla sees initial phase of semi-truck deliveries beginning in December of 2022. That's in like 2 months, folks. So I'm not happy about the margin. I do want to know how much of that was from Shanghai. You know, we did see operating margin trend decently back up, but not as high as what we had in the second quarter. Good move on net income, but net income here less than Q1, right? So look at that. That net income lower than Q1 right here. The estimate for gross margin, by the way, was that we were going to see an increase. We were expecting 28.4% was the estimate. So that's a sad face right here. Tesla down about 4% in afters right now. This is I'm telling you, Elon gave us a bad omen. Growth in vehicle deliveries. Average selling price increased year over year. Declined sequentially. Not good. Not good. Driven by limited Shanghai production, as the prior quarter's average selling price was driven by limited Shanghai production. Average selling price declined sequentially, as the previous quarter average selling price was driven. Yeah, okay, so you had a higher... Oh, that doesn't make sense. Okay, so I need to understand that a little bit better. So quarter over quarter, average selling prices went down. They're up year over year, but they went down, and they're saying because of limited production? Okay, I'm going to think about that one. Either way, average selling prices went down quarter over quarter, but then here they're saying year over year increased average selling prices. Fine. Higher raw material costs and even warranty costs. Did they talk about warranty costs last time? Okay, the FX impact was way less than expected. That's good. 250 mil. That could have been a lot worse. But what's going on here? Cost of production ramp at Texas and Berlin. They're saying negligible or marginal margin impact. Oh, that's a mouthful. All right, we get a little bit of breakdown on deliveries here. That's fine. Solar deployed less than last quarter, but more than what we saw last in all of the quarters of last year. We're seeing more solar being deployed, a lot more storage. Look at that storage deployment. That is an explosion in storage deployment. Wow, that's really, really good. 160,000 drivers had FSD. I'm going to make a quick, we're going to find that. So 2,100 megawatts of storage is great. Still seeing an increase of mobile fleet, seeing an increase here of store and service locations. Fine. Nice bump here in supercharging locations. If we just do some quick math, it looks like it's coming in at what, about 8% or so. Do a quick little calc here. We've got 3971, 4283 divided by 3971. We're about 7.8%. Man, that was a good guess. All right, 7.8%. Oops. So still growing here, obviously still growing the network and the business. That's really important for the competitive advantage. Q3, each of our vehicle factories produced a record number of vehicles, while the availability of components posed less of an issue. Okay, the availability of components posed less of an issue. Vehicle transportation capacity during peak delivery periods became increasingly challenging, gradually shifting towards a more regional mix. Okay. Continue to implement solutions to further increase the production rate in Fremont. Fine. Initial phase of Tesla to semis, December. Well, that's great. Let's see. Rivian, Lucid, Nikola, Fisker are all trading lower post-market. The battery sector was really good this quarter. After production slowdown in Q2, the Q3 rate in Shanghai surpassed previous quarterly records. Our factory in Shanghai remains our main export hub, right? This is why I think we should have more factories in Shanghai. Thanks to strong production rate improvement towards the end of Q3, our team in Germany produced more than 2,000 Model Ys in a single week using 2170 cells. Production rate progress at the factory is still aligned with our expectations. Still aligned, but obviously moving a little slower. Annual vehicle capacity just gives us sort of a total over here. If we do a quick little total up, that's 650 Cali. That puts us around, 1.6 million Cali in Shanghai. And still estimating for over 250K Berlin, Texas. That'd be about 2.1 mil. If we get these fully ramped up for 2023, that'd be about 2.1 mil for 2023. Approximately 160,000 Tesla drivers had access to FSD beta at the end of Q3. Dojo training computer, we learned a lot about that during AI Day. Gigafactory Texas began producing production of the Model Y since earlier this year. Front and rear castings, the single castings, huge for Tesla. That obviously helps with margins. I need more explanation, though, on what happened, why margin didn't bounce more. Why did we miss on margin, right? Energy deployments, this was huge. Very, very good. Demand for storage, right? But Generac is a red flag for this, right? So don't get excited about this because I think Generac and Enphase could be red flag omens for Tesla storage. This isn't so much of the story anyway. This is more of a sideshow. That's fine. Eventually, that'll catch back up, though. But if we go into a housing recession, you're obviously going to have pain in the amount of people deploying storage for their homes, because why would you invest in your home? It's like we say, or Home Depot tells us, during market appreciating times for real estate, investing in real estate is an investment. Investing in your home is an investment. But when prices are going down, any expense on your home is an expense, not an investment. It's kind of interesting. We still expect to average annual growth rate in the 50% territory. So they have not changed their expected growth rate. But that'll, of course, depend on equipment, factory uptime, supply chains, fine, sufficient liquidity. This is true. The pace of ramps in Texas and Berlin will be influenced by the successful introduction of many new product and manufacturing technologies. Obviously, anytime you introduce something new, you have inefficiencies that come with that. So if you're basically creating a new factory system, never going to go smooth. So you would expect that during the earnings call, when Elon is on that we're going to hear about some of the challenges and some of the pain related to that. Photos and charts. Cool. Pretty pictures. Berlin. Yay. Berlin. Yay. Pretty pictures. All right. Shanghai. All right. Welding line in Texas. Texas looks awesome. That actually spells Tesla. See, if you could look at it closely, you could see. They purposely took the picture from the side so you could see it spelled out with solar panels. So again, I want to learn more about when we have this disaster of Shanghai, which is where we actually get higher margins. And Shanghai, I mean, how much has Shanghai been shut down this quarter? Because our margins should have improved and they didn't. So a little strange. Weekly delivery patterns. All right. So this is a little bit of an explanation on why they have some more of the issues going into the end of the quarter. That's fine. You'll probably get some more of that in the earnings calls as well. But yeah, this is not great. Again, Elon's tweet was a bad omen. Margin really needed to have held up here for this to be a good report. And the fact that margin missed and we're mostly done with the Shanghai hell, I don't know how you explain that, but I guess we'll find out. I mean, because their vehicle prices haven't come down, so a miss on margin here is just like, stab in the back. All right, automotive sales. Let's see here. Let's see what we got. So, I already calculated the margin. That's fine. So automotive sales, 1.36. This was in the second quarter. This was the Shanghai hell quarter. So we're over here at 17.8 billion in vehicle revenues. I mean, you have to say like that's pretty great. If you compare to January, 17,785 divided by 15,514, that puts you at, that's a 15% growth in about 6 months. But 15% in 6 months, unfortunately, is 30% annual, right? And 30% annual is not 50%. Okay. And then you also have the fact that you have inflationary pressures. What did they say when they said that they're still expecting 50%? Was that deliveries? Yeah, it was deliveries. So not revenue. It's deliveries. Okay, that's good. All right. Because if they said revenues, then it's like, okay, well, how much of that is inflation, right? Regulatory credits came down in this last quarter over here. Almost the lowest regulatory credits that we've seen. Automotive leasing, automotive revenue, energy and storage. Largest contribution here from energy and storage that we've seen. This is really good. I mean, even just compared to the last quarter, that is 886. Oh, 866. Sorry, 1117 divided by 866. I mean, that's a 29% increase sequentially here, which means quarter over quarter. Good. That's good. All right. Cost. The problem though is their cost of. Oh, they went positive. Oh, they went positive last quarter too. See, in the first quarter they were negative on energy, then they went positive on energy, and now we're still positive on energy. But remember, energy is not where your margins is. 1013, your margins on energy are 9.5%. So your cost is 90.5% cost on energy. Whereas your cost on autos, excluding the reg, divided by 17,785. Yeah, dude, that's not great. The costs on autos came in at, geez, man, that's 26.3%. No, it's the cost is 73.7. 73.7% cost. Yoicks. Not including the regulatory credits. I don't understand why the average selling prices went down either, though. That's the other thing. I'm still not understanding this, because what they're saying here is average selling prices went up year over year, but average selling prices declined in the quarter, as the prior quarter average selling price was driven by limited Shanghai production. Oh, I think what they're saying is that they had limited production, so they were able to keep high prices. That makes sense. Okay. I get it now. So low supply, high prices, Q2. Now back to more supply, so prices are starting to fall, right? So in the short term, you don't have good news here. In the short term, you have the bad margin. Well, I mean, a 20, what do we say? Let's grab that here really quick. Transfer this over. We have 27 6.3. Oops. Here we go. So what do we have in the short term? Stop it. Stop it, you spreadsheet. Come over there. All right. In the short term, we have 26.3% vehicle margin, not including credits per Kevin. Quick math. That's not great. Not great. Shanghai reopening didn't help, which is bad because it means pricing isn't high enough to offset even still mostly declining commodity prices. So input costs are still a pain. On top of that, as more vehicles are sold, pressure is coming to average selling prices. Energy did great, but only has a 9.5% gross profit margin. Gross margin, terrible. After OpEx, basically a money loser now. Okay. So short term, Wall Street will hate this. Tesla's down like 5%. Long term, Elon and team really have to provide some color on why anyone should expect margins will ever be at 30% again. And when are we getting new factories? Honestly, the ramp challenges at Berlin and Texas are probably what are dissuading new factory announcements, which is bad. Yeah, which is bad. All right. Great. Let's look at these numbers a little bit more. Operating, what do we got here? R&D numbers. So R&D, we've got the year numbers are, let me just quickly put a little note there. Those are the year numbers. So when I zoom in, I know what I'm doing. So R&D, and those are to the left. Okay. Oh, well, actually, no, sorry. Year over year numbers are right here. These are the year over year numbers. Let's compare. So R&D is up, divided by 611. R&D is up 19.9% on the year. All right. Then we have SG&A. So this is where we had layoffs, right? This has actually gone down. Look at that. You're negative on SG&A. That's incredible. SG&A cost has gone down by 3.1%. 3.1% year over year. Parentheses means negative, right? So you've actually seen R&D go down. What's this 51? That was, okay, restructure or whatever. Okay. Even if we gave a foreign exchange hit here, let's add the foreign exchange back in, right? So let's put the foreign exchange back in. And let's do 250 mil. Let's assume that gets added to revenue, right? Let's take that. So 17,785 plus 250. That would be 1835. 1835. And now let's go ahead and pull off the costs. 13,099 divided by 13,099 divided by 18,035. It still wouldn't be good. You'd still be at 27.3%. 27.3% margin with 250 mil of FX added to revenue without vehicle credits. Still big miss. All right. Okay, great. I think there you have it. Oh, anyone have any questions? Let me see what Wall Street is saying. We talked about the supercharger growth. First revenue miss since the third quarter of 2021. Started tooling for the Cybertruck, but it's not going to start that until it starts ramping the Model Y more successfully in Texas. Yikes. Where's the end of the pain? Yeah, no kidding. Steve says things are going to get worse next year, not improve. Yeah, probably seeing that margin compression because of the FX as well. But then again, we had a 250K FX impact, and even if you adjust for the FX impact, the margin just still missed, and so that's what's killing you here. That's absolutely what's killing you here. What's this thing trading at now? Isn't it down like 5 or 6%? Oh no, it's actually not that bad. It's recovering. I don't know. Maybe Elon can talk this sucker back up, but in the short term, I don't know. It doesn't seem like good news to me. And it's okay. Like I'm not here to trade this sucker. I'm just saying, like, okay, well, short term, you got headwinds. Long term, I believe that, okay, let me give you this. I believe once Tesla figures out Texas and Berlin, and they can copy and paste those factories, that's when you get margin back over 30%. Commodity inflation comes down. They figure out their factories. They get their act together at the factories. Then you can announce more factories and you build more. They can't copy and paste the model yet because it's broken. It's just not good. So my summary for this Tesla disaster, okay? My complete summary on this. Tesla done screwed up in the short term because manufacturing is hard. Not only is it hard, but ramping Berlin and Texas during this inflationary disaster of a time with a bunch of new employees is hard, and deploying new technology is hard. So unfortunately, we're going through a recessionary time where fewer people are buying cars. The number of outstanding backorder vehicles is declining for Teslas. Average selling prices for Teslas are now rotating down, while you still have cost pressures. And even with a cut of 15% of the white-collar workforce over at Tesla, you're still seeing a margin miss. It's because we're still in the thick of it. And it's not going to be until we get a smoothed out process for Texas Berlin and Tesla for Tesla Berlin and Tesla Austin, Texas. Until that gets smoothed out, probably not going to copy and paste the model because they're still putting in new machinery. They're working new processes, new hiring processes. It's a lot of work. So it's a long-term play. It gives you another bite at the apple of buying the dip pretty dang close to the bottom. Now, the good news is we're actually not falling all the way to the bottom. We're at 213. So like we were here a few days ago, we actually bounced off the 0%, almost basically bounced off the 0% line when earnings first came out. So if anything, that's kind of bullish because it could have been worse. It could have been 10 points worse. Roughly. So we'll see what Elon says on the earnings call. These are my thoughts for now. And you know what? Elon did give us an omen. It was an omen. His tweet was an omen. They knew they were going to miss Wall Street estimates, so we got a tweet omen. I wonder if the SEC babysitter approved of that one. Anyway, folks, have a stamina potion. We'll see you in the next one.